Hello everyone and welcome back to another episode of Palisade Radio. Today we have back on the program Jordan Roy-Byrne of TheDailyGold. Jordan, thanks so much for coming back on the show and joining us today.
Thanks for having me, Colin. My pleasure.
I want to make an announcement. We're doing something really cool here thanks to Jordan. Jordan wrote a book. His new book came out a little over a month ago. It's called The Coming Renewal of Gold's Secular Bull Market. Subtitled, Dump U.S. Stocks and Prepare for Gold's Final Run. It's been a very successful book, and I've been pushing Jordan to do what we did a couple months ago with David Skrika's book, which is give away a few free copies to our audience, and Jordan has said that we can go ahead and do that. So all you have to do is go to palisaderadio.com. There's a big web form right at the top of the website. Type your email in, and you'll get the book sent to you. We're going to leave this open for just a week, so only a few days. So you go ahead and plug that in, and also go to Jordan's site and support him at thedailygold.com. So Jordan, thanks so much for doing that.
No, it's my pleasure, Colin. Thanks for helping me promote the book.
Yeah, and I want to get to some of the themes that you have in the book a little later in the interview, but of course what just happened, we're recording this Thursday around 3 o'clock Eastern time. The Fed just came out, said that they're going to leave rates at zero. I think people were pretty split on if they were going to raise or not. I don't know what your expectations were. It's only been an hour since that decision, so we don't really know what the impact will be. The dollar's temporarily dropped, gold's up, the market's up, but who knows if any of it's going to last. Jordan, what do you think?
Yeah, well, we have to look at the overall market and then precious metals, I think, separately, even though there's some similarities. The overall market has been recovering since that summer sell-off, and I put out a note yesterday to subscribers. I felt that the overall market possibly could rally for another day or two before turning lower again. I mean, the S&P 500, I think it's just above 2000 or 2015, and there's just really strong resistance at 2040. And there's also strong resistance at 2,000, which the market has gone above that today. I wouldn't be surprised if we saw a little bit more strength, but I also wouldn't be surprised if next week we started to see a reversal and the market move lower because the market has kind of, to some degree, been anticipating this from the Fed. It's been in recovery mode, and the fact that it's recovering and it's trading up to strong resistance, that tells you that it's likely to test that resistance and then decline to some degree. Same thing with precious metals, although they're a lot more oversold. I mean, they've rebounded a little bit over the last several days. They haven't rebounded as much as the overall market, but precious metals are going to be testing resistance in the next couple days. I mean, looking at the stocks, for example, GDXJ. I mean, the miners have had a pretty good move the last couple days. The GDXJ is trading right about 21 or a little bit above that right now. I see really strong resistance at 22, 23. There's a confluence of really strong resistance at 23 to 24. And looking at the price action in the chart, I mean, it doesn't look that bearish to me. I mean, it looks fine, but if we've hit a bottom in the miners, GDXJ in particular, you'd like to see that really explode above $23 to $24. Instead, I don't think that's going to happen. Like I said, trading just over 21 right now. It's possible it could push up to 22 or 23. I think if it pushes up and tests those levels, it could roll over in line with the overall market. And the metals, I mean, up until a couple days ago, the metals looked pretty terrible, and they had a big move yesterday, and I mean, they're seeing that again today. So they could obviously rally a little bit more, but I don't see any meaningful bottom there. I think it's a change in positioning. You see a lot of the bears were covering in the last couple days, getting ready for this announcement. And that's pushed the market a lot higher. We'll probably see that reflected in the COT reports in the next week or two. But yeah, I just don't see any reason that this move in precious metals is going to move a lot higher from here, and that we have hit a bottom. But to the same degree, I am going to keep an open mind, particularly with the miners, because they've just been so extremely oversold that, I mean, it is possible that maybe they could base here for the next couple months. I mean, I don't think that's going to happen, but I'm just throwing it out there. I mean, I think it's something to keep in mind. I don't see this bear market lasting much more than another quarter or 2 quarters. Therefore, we need to keep an open mind that there's going to be a big recovery at some point. I think it's inevitable, but not necessarily imminent.
More on precious metals in a minute. The summer sell-off you mentioned in the Dow, I don't think it surprised that many people. We've been going straight up for 7-8 years now, and the bull market is maybe a little bit long-lived at this point. People have different predictions, though, about what is to come. There's some people that think it will continue to rise, especially with the Federal Reserve accommodating with 0% rates. There's other people that think there's going to be a steep sell-off, that a crash like 2008 or something severe over a quarter period is going to come. And, of course, others think that it'll start to peter off and maybe decline and trade sideways. What do you think is going to happen? Because that will have implications for the precious metal stocks.
Yeah, I'm glad you asked that. Well, first of all, I don't think the Fed is really that important right now. I mean, whether they hike by 25 or 50 basis points in the future, I mean, they're not going to hike unless the economy gets stronger and inflation picks up. And even if inflation picks up and they do start to hike, their hikes will lag the pace of inflation. And that's actually why we've seen several times in the past why the Fed has started a hiking cycle, but gold has done well. It's because inflation has risen more or faster than what they're hiking. When they see inflation picking up, they know they have to start hiking. But other than what Paul Volcker did in 80 and 81, they never will hike faster than inflation. So, I mean, I know we're going to talk more about that later, but I just wanted to put that out there. Now, look, one thing I'm looking at is gold against the stock market or gold against global equity markets. I mean, whether you use global equity markets or the S&P or the NYSE, in August, from the beginning of August till the last week or so, gold against equities popped by about 20%. Now it's pulled back, it's weakening now, it's consolidating that. But if we see that make another leg higher, then that's going to be very bullish for gold and precious metals. I mean, another move higher in that ratio, it'll break its 4-year downtrend, or 2 or 3 year downtrend. I don't have the chart in front of me, but that will signal that a new bull market has begun. Now, what gold really needs to see for that to happen, in my opinion, is we need to see the equity market make another move lower. It has to take out that recent low, and I think the S&P was down 12 or 13%. Maybe it from top to bottom, maybe it goes down 20% or 23%. But if we make another move lower in the equity market, which I'm leaning towards that scenario, I think that's going to happen. If that happens, that should favor gold, not necessarily immediately, but I just think it needs to happen before gold is really going to get going and start a new bull market. Now, as far as the equity market, I mean, is this going to be a 2008? I don't think it's going to be a 2008 because, I mean, after you have a big event like that, the next 5 or 10 years, it's always different. I mean, people are always saying it's going to repeat itself. It's going to, the same thing's going to happen again. I don't necessarily agree with that. I mean, I think for the stock market, there's various scenarios. The bulls are obviously pushing the 1998 scenario, where I think the market corrected by 20% and then it pushed a lot higher to a final high. I mean, that is possible. Other scenarios I think to keep in mind would be another bullish scenario would be the 1946 to 49 scenario, where the market corrected about 30% there for 2 or 3 years, and then it continued higher after that. I think the worst case scenario would be something like 1937, 1938, where you see the market. I don't have the history in front of me, but you basically see the market. Maybe this move goes down 30% or more than that. Then you see the market recover for a year or so, and then after that, you see the market make another leg lower. So those are, I think, 3 scenarios that I'm keeping in mind for the overall market. But to get back to the main thing, the key for precious metals investors is just watch the ratio gold against stocks or gold against global stocks. That's what we want to keep looking at, because if we see that ratio break to the upside, which would be in favor of gold. I think when that happens, then a new bull market in precious metals will be imminent.
Jordan, moving on to your book, I want to get some insight onto the title of the book, "The Coming Renewal of Gold's Secular Bull Market." That's pretty self-explanatory. One of the main topics you talk about is that we need to see negative real rates, and I want you to explain that concept in more depth to our audience on what you mean by seeing negative real rates for this gold market to move.
Well, the overwhelming key fundamental driver for precious metals, and I have charts going back about 100 years, when we're talking about real rates or real bond yields, I mean, we're talking about the Fed funds rate and then yields on short-term bonds, I mean, the 2-year, the 5-year Treasury. But looking at all those interest rates as a whole, again, real rates are basically interest rates minus inflation. Gold performs best when real rates are declining sharply and when they're negative and declining. Now, what we've seen over the last 4 years is the real Fed funds rate and the real yield on the 5-year bond, they've gone from being -3 or -4% to 0 or even slightly positive, depending on what you're looking at. So, I mean, I know we have a lot of people saying this is unnatural, you know, the price is being manipulated lower. That's nonsense, because if you look at real rates, they're the key fundamental driver going back 100 years, and they went from being -3 or -4% to 0 or slightly positive in some cases right now, depending on what you're looking at. And some people will say, they'll talk about, well, shadow stats. I mean, there's 7% inflation a year, but even if you look at that, Colin, the rate of inflation, looking at those stats, has gone down over the last 3 or 4 years. So, and people will also say, well, we still have negative rates. I mean, we're not getting, real rates are 0, or you're not getting anything. But the point is, 4 years ago, they were -4%, and they've gone to basically 0. And so we've gone from that change is negative for gold. I mean, things change on the margin. I mean, it doesn't matter. Let's say it went from -10 to -3%. It would still be -3%, but that would be negative for gold because it would change from being really negative to only slightly negative. So it's really the change. And where we are right now, around 0%. I mean, if real rates just go down to -1 or -2%, gold is going to start to go up and do really well. I mean, we don't need to see real rates go down to -5 or even -10%. We just need to see them go negative again, go to -2% or whatever. And Colin, the reason is why this impacts gold so much is because if for all the people out there who hold money or managing money, if you can get a positive real rate of return, putting your money in the bank or a CD, there's no need for gold. There's no use for gold. This is why gold did so bad in the 80s and the 90s, is because the money that you could get from a CD or a bond or putting in the bank, you were making a real return. It was higher than inflation, and that explains why gold performs poorly in those environments. Now, conversely, when inflation is 2 or 3% and you're only getting 0% or 1% on your money, you're not earning a positive real rate of return. So that is why in that situation gold does really well. And again, I mean, I have these charts in my book. I did an update, an August update, and I put a nice chart in there of this. You can see it. It's quite clear. This is the fundamental driving force for gold, not the other nonsense that bulls and bears talk about. And just the last thing on this, when you have a huge sovereign debt problem like we have, like Japan has, like Europe has, the way you get out of that is you have to devalue the burden of the debt through inflation. And you do that by having negative real rates. So the Fed is not going to change their policy and suddenly say, oh, we're going to raise interest rates to 3%. Even though inflation is 0 or 1%. That's not going to happen with the amount of debt that we have. The only way out of this mess, this is what happened in the 1940s, is you need inflation to devalue the real value of the debt. The inflation devalues it over time. And that's why the Fed, even though maybe the economy can handle 1 or 2% rates, that's why they're not raising rates and they're keeping it so low. They have to keep rates really low. They have to keep real rates either at zero or negative, because that is what reduces the debt burden over a long period of time. And if we see higher economic growth and inflation starts picking up at 4 or 5%, they're not going to raise rates to 5% or 6%. They might raise rates to 2% or 2.5%, because if in that scenario, if that happens, they'll just raise rates a little bit, because then that's when the real value of the debt will start to be inflated away. So this is very important to understand, and it explains again, why we're in this bear market, and why ultimately, we're still in a secular bull market, and why precious metals should ultimately go much higher in the years ahead.
All right, Jordan. Well, thank you for that. I want to ask you one last question. When we had you on the show a couple months ago, you correctly predicted what has played out in the precious metals sector. Of course, things have grinded lower for gold, silver, and the mining stocks. Everybody wants to know short-term predictions for the rest of the year. You've kind of already touched on this, but give us one more brief overview and maybe some more insight into what's going to play out.
Well, I think we're at I was going to say a tricky situation, but I really want to see how the sector performs over the next week or so. I mean, as I said, looking at GDXJ, also at GDX, it is possible that the miners could rally a little bit further. I don't have the charts of the metals in front of me. I mean, they're obviously looking better after the last couple of days, but the big picture is still bearish. So I think this little rally that started at the end of last week, I'm not sure how much longer that's going to last. Maybe a couple more, maybe a week or two at the most. But ultimately, I think that's going to roll over again. And particularly with the metals, I think we're going to see new lows in the metals. If not in the next month or two, then maybe at the end of the year, early next year. I mean, looking at where we are, I think the next move down that we get is probably going to be the last move down. I mean, I think we're very close, but looking at gold, I don't know where gold is today, but I think gold is probably going to bottom around the 970 to 1,000 level. I mean, looking at a monthly chart, there's really strong support in that area, and gold right now in the bigger picture, it's just trading in between resistance and support. So even though it's rallying a little bit, ultimately I think that's going to roll over. And when you see gold break below 1080 and decline towards 1,000, I think that's the point when the bear market is really the end of it is going to be imminent. In other words, when we see gold break below 1080, I think that's when we're going to take a strong look at things and start buying. I mean, that's and when gold breaks below 1080, then we should see all these sentiment indicators get into extreme territory again. But I'm not seeing that right now.
Okay, one more reminder, the coming renewal of Gold Secular Bull Market, Jordan's new book. It's going to be absolutely free at PalisadeRadio.com. Just go to PalisadeRadio.com, enter your email at the very top right. You'll see the web form, and the book will be sent directly to you. Jordan, thank you so much for joining us. Jordan Roy-Byrne, TheDailyGold.com.
Thanks for having me, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen? Or are you too stupid?